In the 8 months leading up to June 2026, nearly $2 trillion in total market value evaporated from the crypto ecosystem. The price of Bitcoin provides the clearest map of this destruction. After reaching a peak of approximately $126,200 in October 2025, it fell to an intraday low of $65,700 on Wednesday, June 3rd. The mechanics of this 45% drop suggest a shift in market participation. Billions of dollars in leveraged positions were wiped out on June 3rd, driven by a surge in selling volume from institutional accounts rather than individual traders. Bitcoin's integration into the global financial system has changed the nature of its volatility. To understand why the price is sliding, we have to look at the new rules governing institutional capital. The primary weight on the market is a sustained exit from spot Bitcoin ETFs. These funds, which initially brought billions of new dollars into the asset, are now functioning as the primary corridor for capital flight. Over 9 straight days, these ETFs saw investors withdraw $2.8 billion. BlackRock's iShares Bitcoin Trust handled the majority. The fund saw over $2 billion in outflows, including a single-day exit of $527 million on May 28th. This data indicates that the sell-off is being managed by professional asset managers. These are calculated, high-volume liquidations performed by the same institutions that drove the 2025 bull market. Adding to the institutional pressure, Saylor's firm, Strategy, reported its first Bitcoin sale in 4 years. The sale involved 32 Bitcoin, worth about $2.5 million. Compared to the firm's total reserves of 843,000 coins, this disposal represents just 0.004% of their holdings. While the amount was small, the action impacted market sentiment. Because the firm is a high-profile advocate for long-term holding, even a minor sale can trigger a broader reassessment of the asset's near-term strength. Beyond individual sellers, broader economic forces are pulling capital away from crypto. Bitcoin's price has become increasingly sensitive to federal interest rate policies and the strength of the US dollar. With the Federal Reserve maintaining high rates to combat inflation, many institutional investors are moving money out of volatile assets. Much of that capital is rotating into traditional semiconductor and AI stocks, which are currently seeing record high demand. By achieving full integration with Wall Street, Bitcoin has become a standard part of the global risk management cycle, making it vulnerable to the same rotations that affect any other tech-heavy investment. Measured, this close connection to traditional finance leads to a central question. If the big institutions are currently leaving, why has the price found support in the mid-$60,000 range? Analysts like Tom Lee suggest that the current level of anxiety often marks the limit of a sell-off. In previous cycles, when ETF outflows and high-profile sales reached these extremes, it indicated that most of the available selling pressure had already been spent. Data from prediction markets like Polymarket supports this outlook. As of June 3rd, the market is pricing in an 82% probability that Bitcoin will stay above the $57,500 mark over the coming month. While the daily headlines focus on the crash, the data suggests that most market participants view this as a temporary correction rather than a total collapse. This stability is the result of a demand floor that did not exist in previous years. The introduction of U.S. regulatory guidelines for ETFs has established a permanent infrastructure for institutional capital. This setup allows big firms to move back into the market just as easily as they exited. AI models are already forecasting a reversal. Some projections target a recovery to the $88,000 to $95,000 range by the end of June, based on the expectation that institutional flows will return as soon as macro conditions stabilize. This creates a new reality for the asset. The same institutional systems that allowed for a 45% price drop are also providing the liquidity and structural support that keeps the price from falling to zero. Bitcoin is no longer an isolated experiment. It is a standard component of the financial landscape, one that is vulnerable to Wall Street's exits, but reinforced by its infrastructure.